Hi, this is Rick Masnick of Network Funding coming to you with your Mortgage Minute. You know that your income and credit are important components when qualifying for a mortgage to purchase a home, but what about your debt to income ratio? It's probably one of the most important factors in determining whether you can afford the home that you're looking to purchase or in determining just how much of a home you can go shopping for. Your debt to income ratio, or DTI, is actually made up of two different numbers. First, you've got your front end or primary housing ratio, and then you've got your back end or your total DTI. That primary housing ratio on the front end is comprised of your anticipated new home payment, and that's your mortgage, which is your principal and interest, your monthly property taxes, your monthly homeowner's insurance, and if you're putting less than 20% down, you're going to have something called PMI or private mortgage insurance in your monthly payment as well. We're taking that entire housing payment and dividing it by your gross monthly income, not your take home, your gross monthly income, and that's how we come up with your primary housing ratio. Now, your back end or total DTI is comprised of that same house payment I just described, plus all the monthly payments that are on your credit report, car payments, credit cards, student loans, things like that. We're not factoring in your cell phone bill or your electric bill, things like that. So if we take that entire figure and divide that by your gross monthly income, we're coming up with your back end or total DTI. The mortgage program you're applying for will determine just how high we can go on that DTI. If you take into account the fact that something like a USDA rural housing loan has a no money down program, that's 100% financing. Well, you can expect the guidelines on the debt to income ratio to be a little stricter on that. You're going to cap you at about 41% with a good credit score, 45% on a conventional mortgage. And then if you're going with an FHA mortgage, and you might need to because their debt to income ratio guidelines are a little more liberal, you can go up to 50 and sometimes a little bit over with compensating factors. So all of those items are going to determine just how much of a mortgage you can get qualified for. And if those two debt ratios, your primary housing ratio and your total debt ratio, are close to each other, then you're still not going to get the mortgage, even if that total debt to income ratio is below the guideline of the application or the mortgage you're applying for. Reason being is this. Let's say you're applying for a mortgage on a conventional mortgage product and your debt to income ratio is 44%. The guideline limit is 45%, as I mentioned just a moment ago. But if your two debt to income ratios are close, that probably means you don't have any bills on your credit report. And if that's the case, and you close on that mortgage, and a few months after closing, your car dies and you need to go buy a new car, that mortgage payment is going to make your debt to income ratio go up. But more importantly, it's going to put a strain on your monthly budget. The guidelines are in place as they are, not to make it tougher for you to purchase a home, but to make sure that once you've purchased the home, you're living in it and enjoying it, you're not going to have any stress over being able to make the payments on that mortgage. So that's what your debt to income ratio is, and that's the role it plays when you're trying to purchase a home. I'm Rick Masnick, and this has been your Mortgage Minute. Take care.